Welcome to From Our Generation, where we uncover the ideas and events that shape the world we live in today. I'm Crom Carmichael.
And I'm Mike Hassel.
Together we'll explore the past to better understand the present, because history isn't just about what happened, it's about how you think about it. Well, Michael, here we are from Our Generation. It is May 30th.
2025.
2020. Thank you very much. And we're going to be discussing a topic today that a lot of people would say is kind of dry. So I'm encouraging our listeners to hang in there with us because, as you and I kind of discussed before the program, almost everyone would like to become financially independent, and that it is becoming financially independent is elusive for way too many people.
Yeah, I'm going to start out by disagreeing with you because I think that's very interesting and not dry at all to wonder what wealth is and how can I get more of it.
Fair enough.
Right.
Fair enough. So we're going to break this down into kind of four topics. We're going to first talk about what is a market, and then we're going to talk about, we got it right up here on the board here, what is capital, what is profits, or what's profit, and then what is wealth. We're going to talk about those four things because they're all interrelated, but they're not the same.
Yes.
But they all are part of the same tapestry.
In the last week, I've asked a few friends and family, what is it you wish you knew better about profits and wealth?
Okay.
And the answers were not very forthcoming. So everybody thinks they have an idea of what profits and wealth are, but I would submit that there's a lot of what we called half-formed ideas.
Yeah.
And a lot of distorted ideas because of what we hear in the media about what's good and bad about wealth, what's good and bad about profit, et cetera. A bunch of agendas that are pushing on these all the time. We're trying to cut through that to give a clearer vision, our view of what these things are.
Mm-hmm. Mm-hmm. Let me give one real quick example to talk to your point about how the media will distort things. And because there are all these agendas, as you say, and they're out there. And that is, if you'll recall, back when the election was going on and the Democrats were claiming that those nasty grocery stores were charging too much for groceries because inflation was driving up the grocery prices, and the Democrats were calling for price controls on grocery stores.
Well, because they were exploiting the situation by raising prices.
Yeah, because they were raising prices. And so I asked a few people, I said, for every dollar that a grocery store sells, how much profit after taxes do you think that grocery store has? For every dollar, how many cents? And the typical answer I got was between 15 and 25 cents. So 15 to 25% of that dollar of sales, people said was profit. And you know what the answer is because you're familiar with the industry.
It's about 2.
About 2%. And that's a well-run grocery store makes a profit of 2%.
Right.
Yeah. And so if they lowered their prices 2%, they'd make nothing.
They'd
make no profit at all. They'd make nothing. So there's a lot of distortion. So let's get into the subject, and we're going to first talk about define. And by the way, this goes back, Michael, to our first 2 episodes on the island, where we tried to define terms in very specific ways so that we could then use that definition as we then built a model of how to think about different things.
So just for anybody who hasn't heard that yet, they should go back and listen to it.
Yes.
But it's the simplest form of an economy, 10 people, and we build from there, complexity from there, because complexity hides a lot of these basic insights about how things work.
Well, and the other thing that hides the way things work is when a society reaches a certain level of prosperity. When the whole society does, then it gives the people in power the ability, they actually have the ability to be very wasteful and to reward their friends.
Sure.
Whereas if you're having to work 16 hours a day, 7 days a week to survive, and 10 people have to work 16 hours a day, 7 days a week to survive. If you're in that situation, there are no resources that can be wasted because every single hour of the day is used to survive.
Yes.
And so that was kind of what we did. And we encourage people to find what we talk about to be interesting, to go back and listen to those first 2 episodes because they are foundational in nature.
Yes.
So let's talk about this. What is a market? How would we define a market? Now, this is a general term because there are lots of different kinds of markets. But how do you define a market?
I would say it's a place of exchange.
Okay.
I'll just use 3 words.
Yeah.
Although markets don't have to be a physical place anymore. Amazon is a market,
Right.
So we can liberalize from that.
Mm-hmm.
But generally, historically, it's a place, there are things called market towns where farmers come in and they exchange goods on Saturday and then they go back and produce the rest of the week.
Yeah, farmers markets.
Yes.
Farmers markets. And so but let's talk about and so we're going to break markets down into a couple of different general categories. One is free markets, and a farmer's market would definitely be a free market. And I'm going to define the farmer's market in this way. Farmers come and they all sell the products that they grow, and a number of the products that one farmer might be selling is the same products as another farmer is selling. So farmers set the prices of their products, and then the customers decide whether or not they want to pay that price.
Well, you might say that the customers set the price of those products because they determine what they're willing to pay, and the producer either will or will not sell it.
Yeah, well, they
discover those points by barter.
Right. Well,
by
they set
negotiation.
the customer sets the ultimate price.
Yes.
But the seller generally sets a price, and so if you go on to Amazon,
it's an offer price.
That's an offer price.
And then there's a buy price.
Yeah, and most of the time in the U.S., if you go online to buy something, and they say it's $25 if you want to buy it, or say on Amazon or any other website. Generally, you're not sending an email saying I'll pay you $24. You don't do that. You don't bargain. You either decide I'll pay that price or I won't, or you search around to try to find the exact same thing that somebody else will sell to you. But the purpose, the goal in a market, or in order for it to be a free market, is there has to be freedom on behalf of the sellers and freedom on behalf of the buyers, and that's what a free market is. Yeah. Now, in the United States, a lot of the markets in the United States are what I would describe as generally free markets. Okay, they're generally free. However, there are lots of markets in the United States that are regulated markets. Now, so let's define what a regulated market is. When you have a regulated market, the government is involved in either setting the price or setting the level of service. Now, let me go back in history a little bit. Back when in the 70s, in fact, it was when I met you, and your wife worked for Converse athletic shoes.
Right.
We were a Converse distributor, and we would buy shoes from Converse, and they would ship a full truckload from their warehouse in Lumberton, North Carolina, to our warehouse in Columbus, Ohio. The company that we used to transport the shoes had the right to do that from the government, and the price that they set for hauling shoes from North Carolina to Columbus was agreed to by the government. So we didn't have choices. There was not competition because the government decided who would have the right to haul shoes. Now, the government—
There were a number of markets that were like that. Phones were that if you used the phone, you paid what the government commission had said.
Well, AT&T back in those days was a government-sanctioned monopoly, which is kind of another form. But the point is, it's not a free market.
Yeah, they got that monopoly by agreeing to be regulated by the government.
Right.
So the point is, the prices were not free.
They weren't free, and you were not free to compete.
And I don't mean no price. I mean they were not free to change
based
on the buyer and seller's negotiation.
Right, and that was also true with airlines. If you were an airline and you flew from Nashville, Tennessee to New York, if some other airline wanted to fly from Nashville to New York and lower their price, they couldn't do it. And so there are a lot of businesses that were highly regulated by government in terms of their price and in terms of their service, what they're allowed to do.
And let's just make sure we acknowledge they still are. Minimum wage rules are a regulation. I cannot sell you my labor for $1 an hour.
Right. Right, and many utilities are still highly regulated by the government. And I believe you and I generally think that you eventually reach the lowest price for a given level of quality if you have a free market. We generally believe that.
Let's just stop to make sure I understand what you said. you reach the lowest price, meaning the market competes away excess profit. Somebody
Correct.
else is willing to sell it for less. They'll settle for a lower profit, and I'll buy it from him instead of you because you're so greedy with your pricing.
Well, they might settle for a lower profit, or they have figured out a less expensive way for their business to operate.
Good point.
And so if they figure that out,
that's a better point.
Yes, and so and that's where freedom comes from, because generally speaking, especially in the area of manufactured goods and goods that evolve over time, businesses succeed by lowering their their cost of production. That's how they make more money, is lowering the cost, not increasing the price.
Yes.
And you have to be free to do that in order and to benefit from doing that. Or otherwise, it doesn't happen.
I was at a business school reunion once, and the professor was talking about this cycle of innovation is always undercutting. Supermarkets undercut local grocery stores, for instance.
Yes.
Big box stores now have undercut the Main Street merchants.
Right.
And I said, well, what about FedEx? They came in when they started, it was $10, $20 a package, and U.S. Post Office was 30 cents at the time, first class mail. And the professor said they were not competing with the post office. They were competing with hand delivery. My wife used to get on a plane in Boston and fly to New York to make sure somebody had something the next day.
Yeah.
Hundreds of dollars, plus the fare, plus the hotel, all her time for 2 days. Now she could do it for $10. They were undercutting the price.
Right, and their motto was, if you absolutely positively have to have it the next day.
Yes.
And that was their motto.
Yes.
And the post office couldn't do that.
Right.
So your point is
markets are excellent at finding those kind of innovations that cut the costs. That's what the private sector does. It's not what the public sector does.
Right. And so then the other form of market is what I call the markets that are not only regulated, but where the actual price is extremely opaque. That will never happen in the absence of government making it so that will happen. So healthcare is an example where the prices are opaque. When you go in to see your doctor, you do not know what the price will be. You simply don't.
Right.
If you have outpatient surgery, you do not know what the price will be. In fact, you're not even able to pay for it. If you have insurance, you're not able to pay or negotiate a price. And that's the way our healthcare system is set up. And by the way, we had a previous podcast on healthcare, and we pointed out that system, the way it is organized today, costs our society trillions of dollars. Trillions, not billions, trillions.
Right.
And then the other one that's very opaque, it's a big industry, is education.
Yeah.
It's because in the case of K through 12, if it's public, the taxpayer pays for it. So the customer, the parent doesn't pay. And who is the customer always? Who is always the customer?
The person paying.
The person paying. And so
or the entity paying.
Yes. And so in public education, K through 12, it's the politician that the schools answer to, not the parent.
Right.
And that is part of the reason that our educational system spends more money than any other country, and our educational results are, one could say, they're deplorable, especially in big cities. They're just terrible.
Yes.
And then even in higher education, there's a very interesting battle going on now about foreign students. Apparently, Harvard, about 25% of their student body is from foreign countries, and they pay the full price. Well, very few other people who go to Harvard pay the, quote, full price.
Yes.
So there's all kinds of grants, there's all kinds of scholarships, and in the case of public universities, and there's some public universities that are very, very fine universities, but the price is subsidized by the in-state taxpayers, generally 60 to 70%.
So free markets are transparent and they're independent of regulation.
Yes. Yeah. And those are the markets where ultimately the buyer generally gets the very best price. And restaurants are another example of a free market.
Right.
And if people go to a restaurant, you say, well, how was that restaurant? And if I responded by saying the service was excellent, I thought the food was delicious, and I thought the price was very fair, that's a recommendation that other people say, well, hell, I think I'll go to that restaurant myself. But if any of those three things are not good, there's a good chance that restaurant will ultimately fail.
One of the bottom lines here is how much choice does the buyer have?
Mm-hmm.
Because if I don't like the price you're offering me, Crom, I can just go down to the end of the table and get it from our colleague here.
Right.
Right. And if that choice is restricted, then I've got to pay, if I've got to have it, if it's insurance, if it's fuel, if it's food, if it's healthcare, I may be paying a lot more than I could if somebody else were free to offer me a better price.
Right.
So we have all kinds of choice movements in the country, for instance, about education with vouchers and things like that. One way of looking at that is that anything that empowers the purchaser with more choice should lead to more efficiency, better value for the dollar.
As long as the sellers are all participating under the same rules.
Same rules.
And
yes.
that is essential. Adam Smith, we have, our program that we sell, The Giants of Political Thought, which go to giantsofpoliticalthought.com and look at the great thinkers. And I encourage all of our listeners to do that. But Adam Smith, and a lot of people who are for, quote, global trade, regardless of whether or not the other side is treating us the same way that we're treating them. A lot of people say that's free trade, and Adam Smith made it very clear that free trade requires all the participants on both sides, buyers and sellers, to be equal, equal on the playing field. It's kind of like in a football game. The goal of the referees is to make sure that everybody is playing by the same set of rules.
Yes.
And in global trade, unfortunately, we've gotten to the point where a lot of countries are not. And so
we've
we'll
dug
leave
into
it
a
at
lot
that.
of subtleties about markets.
Yeah.
Let's lay a little hint here that we're talking about wealth eventually.
Right.
What is wealth? How do we get more of it? It's
Right.
going to involve some of these subtleties. One clue is wealth is often financial, but not always.
Right.
So we're going to get into a broader talk about what wealth means. What is it? What's the means and what's the ends?
Yeah, and so we're going. Just to put a final little thought on the markets part is that if a country is generally a free market country, then wealth and if taxes, if the government has a light hand,
yes,
then because human beings have a natural tendency to want to improve their lot in life, then the economy will grow. And so if you want to have individual wealth, you want to be a participant in that growing economy,
yes.
Not just as a laborer, but as an investor.
And the government having a light hand is a really critical phrase because that's really what our founders set out to do. We've done a bunch of publications about this in our Knowledge Product series before, and their explicit intention was to design a limited government.
Right, limited government. And we also have done a previous podcast on the difference between what is productive and what is not productive.
Right.
And that gets into exactly what we're talking about. So for people who are interested in that, they can go back and listen to that particular podcast. But the second subject that we're going to cover is what is capital? So what is capital? How would you define capital? And it's fine if you want to break it down into different categories or just have one overriding with subtopics.
The simplest word I can come up with, but let me elaborate on it, okay, is savings. Okay, it's the corollary to what a person would have as savings. It's what you have left over after you've paid your expenses. You get your revenue, you pay your expenses, and we can go through a bunch of different levels of it. There's variable expense, there's fixed expense, there's indirect expense like for your offices and your lights and things like that have to be allocated. Take that out, and then in the end, you got to pay your taxes, and whatever left over is your net profit, right? And so you have that money. You can accumulate it to be able to reinvest in your business, to buy something else, to buy another business, but it accumulates. The financial capital accumulates over time. It kind of like savings do for an individual. Okay, but that is financial capital.
Right.
There's a bunch of other kinds of capital that is very important to both of us. On the island, when we started out, there was no money. You're not going to be accumulating anything except maybe less time. You get efficient and you have more leisure, and that's a form of capital. But time is your capital, what you have to invest to make things better.
Right. Well, in the case of the island, when you woke up every morning, you didn't have anything except 16 hours to be awake, and you had to invest that time. That was your capital. Your 16 hours, that was your capital.
Right.
Was the next 16 hours, how are you going to invest that time to get water, to find food,
Yeah.
to survive. You had to deploy your capital wisely.
Yeah.
Now
And you might say it included your manpower, your brain power, the other resources that you have to bring to bear. This is a kind of broad idea of capital.
right.
But we also hear people talk about political capital or social capital or spiritual capital.
Right.
These are reserves of something that's built up that can be spent to reach an objective.
Yeah, and the reserve is the key part in what you're talking about there. But then you get into you have another form of capital which is extremely important in the well-being of countries, and that is intellectual capital.
Yes.
Or intellectual property.
Know-how.
It might be a copyright. Well, it could be know-how, or it could just be that you invent something that nobody has thought of before.
I see that as know-how, but okay.
Well, when I think of know-how, it's knowing how to do something better. That's an improvement. But I'm not trying to get into. But we have in our country, if somebody writes a song, they can copyright that song. If they write a book, they can copyright that book. And then if people buy that book or they buy that song, other people cannot just copy the book or copy the song, and they can't do it legally.
Right. And for me, I know how to express this emotion in music better than anyone else. And so you can't just take it and use it for your advantage. I've created it.
Right.
To me, that's a kind of know-how. But apart from these nuances.
But that's on that. But then on the IP part, the patentable parts, this is where people will come up with ideas or innovations that nobody has thought of, and that isn't simply improving on something else. So there was a wonderful story about this guy that his company is the largest producer of plastic bottles in maybe the world, but certainly in the U.S. And he talked about the evolution of his business and how thick the plastic bottles were 20 years ago. I mean, what I'm saying is that article was so fascinating over how he said we're in the business of constantly improving our product and our methods of production. And if we weren't in the business of constantly improving our products and lowering our costs, we would go out of business because
somebody else would do it for you.
Somebody else would do it. And that's the magic of a free market. That's the market.
Which requires constant reinvestment.
Yes.
You just can't accomplish something and they'll live off it forever. There are some families, think businesses that last 100 years. This is another thing I learned at business school where one of the professors asked why it was the Fortune 100 from 1920. All of the companies almost gone.
Right.
Very few. I think now GE's gone.
Yeah.
It's split up into various things. And the reason is they have vested interests, and other people are constantly coming in and underselling them. They're more flexible than these old companies that are protecting what they've accomplished.
Mm-hmm.
And so the nature of a dynamic economy is to constantly be there was an economist, you remember?
Joseph Schumpeter, dynamic destruction was what he called it, dynamic destruction. He said the market would
creative destruction.
Creative destruction. Yeah, thank you. Yeah, and so that's what happens is that people see how somebody is currently doing something, and they say, "Well, I've got an idea that I can do it better and cheaper."
Right.
And that's I can do it better and I can do it cheaper. And by the way, the consumer will always gravitate toward something that is better and cheaper.
Right.
I mean, that's their nature. That's the nature of the consumer also. And so capital, invested capital, money, resources, it gravitates toward better and cheaper. Those who can make things better and cheaper. And so for those businesses that do figure out how to do things better and cheaper, if you are a shareholder in that company, the value of your equity in that company will rise much more quickly than if you an investor in the companies that they are displacing. In fact, the companies that they're displacing may go completely out of business. So part of thinking about capital, especially if it's your capital, when you began with the process of your savings.
Yes.
You want that to be invested not necessarily in a company unless you own the company, and you have control over that. You want to be investing in ways that ride the general improvement in the economy, and so that you have some diversification. And
so another hint of where we're going here is that wealth is generally not a pile of money sitting in a bank.
No,
it is ownership of equity in businesses that have found a way to perform better than others. It's know-how, it's intellectual capital, it's financial capital that are reserves. Microsoft and Apple and Google have billions of dollars in basically cash that they can invest when they see an opportunity.
Right.
A bad company is one that has no place to invest their cash, and they're not giving it out in dividends. They're just sitting on it. That as a company, you should sell the stock.
Right.
And sometimes a sign that they're just giving out money to shareholders means they don't have anything better to do with it, and so they're not really very with it. And maybe there's a warning signal there.
Yeah, and there are some companies, Mike, that people can invest in where they pay a very nice dividend, and the stock itself may grow at say 5 or 6% on average a year, but they pay out dividends of 5 or 6% a year. So if you add those two together, you're getting north of a 10% return, maybe even a 12% return.
It's pretty good. But historically, those are things like utilities. They're entrenched. They're not easily displaced. They're going to continue to churn along, not make huge innovations, but just reliably make a nice margin.
Yeah, but even in those companies, if you're an investor in those companies over a long period of time, while the growth of your wealth may not be as great as some others, it still goes in the right direction. After factoring in inflation.
Yes.
And
the opposite case of that is Amazon. For 20 years, they never distributed any dividends.
Right.
They kept reinvesting their profits. And so the value in that became in the stock. You had to sell the stock to realize the gain.
Right.
But it was galloping, getting more and more valuable at an enormous rate.
Yeah.
Right.
Now,
so there's just different ways. There's capital appreciation is what we'd call the latter.
Right.
And there's dividends. And a good investor is going to want some mix of that.
Right. And by the way, when we're talking about acquiring personal wealth, at this point, we can talk about it. We'll reiterate it again later. But part of what we want to talk about from an individual standpoint is you really want you want to have either an IRA, a 401k. You want the assets that are growing for you to be growing tax free. Yeah. And during the time that until some particular point in time, and our government, I guess maybe 30 years ago, they passed laws to allow people to invest their money in what are called individual retirement accounts. That's an IRA, and then they also set up where companies could offer a 401k.
Which refers to the part of the tax code that allows these kind of accounts.
Yeah, at least there are different kinds of accounts, but they have the same the same tax deferred nature to them. Now, just very quickly on the 401k, a lot of companies will match the amount that the employee puts in the 401k. Sometimes it's 100%, sometimes it's 50%. But in whatever it is, if you are working in a company that has a 401k, you should take advantage of that absolutely as much as you possibly can if they're matching it, because that's an automatic win.
This is a key insight for our younger listeners. When my daughter started working and had this opportunity, I said, Emily, you have to put in at least as much as what they're matching. Right. I recommend more, because she had to defer some purchases she would have made, and live better with the money she was making. But I said, you have to put up what they will match, because that is 100% return on investment,
right?
ROI.
Yeah. Okay? If they match it dollar for dollar,
you
put up a dollar.
One, there's two in there next year.
Yeah.
Or whenever they match it. It's usually not immediately. It's 6 months. They want to make sure you're going to still work there, and then they'll put it in after you've stayed there for a year. But then you get the increase. A dollar turns into $1.05 or $1.10. Yeah. Over time, the average is 7% in the stock market. So 7 plus 7 plus 7 over 50 years matters. That's compounding interest. But the matching part is what we're talking about here. 100% ROI is not available mostly anywhere, particularly risk-free. That's risk-free. You get it. You just put the money and you get 100% ROI.
Yeah. Now, so let's talk a little bit more some other forms of capital, because a lot of what we're talking about is what we would describe as liquid capital. meaning that you invested in a stock, and if you want to sell the stock, you can. The price may be lower, the price may be higher than the time you paid for it, but it's liquid. If you own Bitcoin, I think I don't own Bitcoin. I wish I did. I wish I'd owned it for 10 years, but I don't. But I believe that Bitcoin has it's pretty liquid. I believe gold is certainly liquid.
So liquid means you can readily sell or buy it. I can go to a stockbroker today and sell something that's publicly listed. Illiquid is a private entity that's not being traded on an exchange, and you've got to go find a buyer.
Well, there's some things that are there's liquid, and then there are various forms of illiquid. So, for example, if I own real estate, I can sell my real estate, but I can't sell it tomorrow.
Right.
I might, but chances that I can sell it immediately are very, very low.
It takes generally weeks to months to structure deals like that.
Right. But real estate is a form of an illiquid asset that's not completely illiquid.
Right.
Okay. But if I own stock in a company, a private company, and I'm a minority shareholder, finding somebody to buy my shares at anywhere near the actual value is very difficult.
I had a classmate who described his beer as his liquid assets.
Okay.
So it wasn't an asset at all. It was a consumable item, right? It was not going to be providing any kind of growth, but it was pretty clever, I think, to describe it.
Yeah.
So I think we can say there's all different degrees of liquidity. How easily can you get in and out?
Right.
Matters.
Right. But I want to talk just on capital. So all the different forms of capital that we've been talking about so far are forms of capital that you and I think if they're reasonably wisely invested, they will go up over time.
Right.
So if you own real estate will if it's in a good market, it should go up. The value of it should go up over time.
Right.
Real estate is one of the very unusual types of investments because if you are an investor in an income producing form of real estate, you actually get to depreciate the value of the capital cost, not the land, but the building. So you get to depreciate that. So there are not many things other than real estate where you get a tax deduction on something that's going up in value. Yeah. Whereas capital goods, and this is very important as we look at our economy today, capital goods where you buy equipment to make things, those capital goods go down in value over time.
They depreciate.
Now, a business gets to write off the depreciation. They get to depreciate it, but that asset is going down over time, whereas real estate is going up over
this
time.
Is where one of the lower levels of costs, which said variable costs, fixed costs, and then there's allocated indirect costs. These costs are in that category that require good accountants to get it right because you can really screw yourself up if you don't allocate properly.
And we're talking, the last part that we're talking about is a business. Individuals don't own capital goods in the sense of equipment.
Yeah.
If they do, they are operating a small business. But an individual investor might own a duplex, might own some rental property.
Yes,
and so that would be a form of capital, and it would be, and the value of it would generally in a good market, if you take care of the property, it will generally go up over time. So
let's interject at this point. We're getting down in the weeds about some aspects of financial capital, certain types of assets. Let's say that financial capital is a means to another end.
Right.
It's not an end in itself.
Okay.
A lot of people think of getting wealthy as an end in itself. It is not. As David Geffen says, anybody that thinks money solves all your problems does not have money. Okay. He's been there. He has the money. It does not solve all your problems. It's a means to an end. It's a poor master, a great servant. If you can make money work for you to get what you want, it's great.
Yeah.
If you are a slave to money, debt, whatever it is, you're urged to get more and more always, no matter how much you have, that enslaves you.
Yeah, it can. Yeah.
It can. And so the point I want to make, and we're going to get to this when we talk about wealth, is that money or financial assets. Financial wealth is a means to other kinds of wealth. So social capital, for instance, is how many friends you have, how big your family is, how well your family gets along together.
Mm-hmm.
Sometimes money can make that better because it produces opportunities for people to be better educated or whatever. My point is the financial capital is not the be-all, end-all. It's the means to something else.
Right. Okay. That's a fair point.
Yeah.
That's a fair point. So we kind of got down in the weeds a bit on capital because there's individual capital and then there's business capital,
right.
and they use the same term, but they are applied differently. So let's move to the next topic up here, and that is what is profit. And in this case, we're only talking about businesses. We're not talking about an individual's profit.
So my simple explanation or answer to that is that it is what's left over after you've received your revenue and paid all your expenses.
That would be a very good definition in a business that doesn't have any capital equipment.
Well, I would say if you have capital equipment, you've got to charge that off in your profit. There's cash flow. Some business just operate on cash. You're saying if that's not a cash expense, you might have.
It is a cash expense, but it's not but it affects your profits. And it doesn't fit your definition.
Yeah.
You said after you've spent the money, and if it's expenses, you're correct. It's revenue minus your expenses if you're not in the business that requires buying equipment. And by the way, or if you're in the business like let's say a grocery store chain, and this is where a lot of news programs do a absolutely terrible job of educating their consumers, because a business that is that grows by location, if it has positive cash flow, it is taking that cash flow and investing in new locations.
Yes,
it is not accumulating cash on the balance sheet. It's not even paying it out to its investors. And in fact, its investors will not see the value of their stock go up unless the business is opening new locations, i.e., unless it is growing. A lot of times they'll talk about big retailers. They'll talk about Walmart, and you'll hear them talk about same-store sales.
Right.
Same-store sales went up 2%, or same-store sales did this, or same-store sales did this. But Walmart, over the long time, where the company itself grows is not by increasing sales in the stores they already have. It's by adding new stores or new types of stores.
Right.
So, for example, when Walmart first started, they didn't, and this is a really good example of a business that evolved over time to meet its customer needs and to constantly try to lower the costs of doing business to provide the same service. But Walmart started selling things, and it always said that its price would be the lowest. And then it went from selling things in a Walmart store to selling things and groceries.
Yes.
That then became the Walmart superstores.
Yes.
Because it sold both. Well, now what you have is Walmart is still increasing the number of superstores slowly, but where it's growing the fastest is neighborhood supermarkets.
Right.
Where they don't sell things, they sell only groceries, and they're able to target smaller markets.
It's very smart because people already were there shopping, and they could do two things at once, so it's more efficient for them. That's why new car dealerships line up in one place, because they know that buyers coming there to make it efficient for them to choose.
Right.
Kroger you'd think would be hurt by this because now they have new competition in groceries. But Kroger's the same story. They are now one of the largest pharmacies in the country, one of the largest fuel sellers, and one of the largest florists.
Yeah, and
so they're doing the same thing.
Yeah, exactly. But the key point here is, Mike, that they're taking their profits and they're reinvesting it in either offering, in the case of Kroger's, using the example, either adding a pharmacy to their stores, adding a floral shop to their stores, putting a Starbucks inside the store. So they're doing different things, but they're doing it with their profits.
Yes.
And so when you hear Democrats or you hear any politician, but it tends to unfortunately be Democrats, they complain about profits, okay? But profits are not just a boatload of cash sitting in a bank. Businesses take those profits and they invest it in other things to help the business, to make the business so that it grows. And then that then benefits the shareholders which are the very people that we're talking to right now, who eventually they want to become what we call financially independent. And you become financially independent by investing in others. You don't become financially independent by working yourself and taking your excess and investing it in the bank and getting a 2% or 3% bank return. There's nothing wrong with a 2 to 3% return for your checking account or for a savings account that's being used for your, I'm going to call it your emergency fund, so that you've got something.
Highly
but if you're
liquid,
yes,
something, the money is available today if I need it.
It's something that you need, and so you have that. But what you want to be doing to grow your wealth is you want to be investing in businesses or in real estate or things that are going to increase in value.
So let me ask you this question. Is there a level, a number beyond which profit is bad? Are there limits on what are good profits and when they turn into bad profits?
Well,
let me elaborate on this because we've heard about windfall profits.
Yeah.
Some of our listeners may be too young to remember when gas prices got really erratic and they were like a bungee, or yo-yo, going way up and down. And the net of this was some of the oil companies would have these gargantuan profits after prices had gone up, and then their cost went down, and until it all adjusted, it doesn't happen immediately. They had some really pretty big paydays, pretty big profit reports. Is that bad? Is it evil to have a huge profit? Well,
it depends on what drove the profits, and in the case of the oil companies. Some people say the oil industry is rigged. I don't believe that. It's a global market. I mean, because there are different grades of oil, but oil is oil, and
it's a commodity.
It's a commodity, and so you can take a relatively low grade oil and run it through a refinery, and it might cost you a little more to refine it, but the end product is the same as a high grade oil. Now, the cost of refining is different, but when prices go up that are commodity driven, you really want to let them go up, because that will then, the only reason they go up is there's some disequilibrium between supply and demand at that particular time. And if the prices go up and you don't Jimmy Carter tried to address the oil prices by setting a price that they could that gasoline companies couldn't sell.
Price controls is one response, but windfall taxes is another one. We're going to take it away from you if you got what we consider to be a windfall.
Right.
Now, let me analogize this to the founders of Google and Apple and Amazon. Netflix, these are a core of stocks that have just outperformed everybody else for a long time now. Is what they have done evil? I would say no, it's tremendously productive. Amazon is created like the universal marketplace. It's very easy to buy things.
Right.
Google indexed the world. I can go to a computer anywhere, write in something, and it will give me a bunch of answers, just like looking at indexes in a book. That's the way I think about it.
Okay.
Microsoft created standards across all of these personal computers where I could operate them all and they would talk to one another. You didn't have to have a government impose a particular language.
Watch that cup.
I knocked it over before. I won't do that again. But the point is they created something enormously valuable, and over time it will get competed away. Intel was a semiconductor that ruled the world about 20 or 30 years ago.
Right.
The guy that ran that said, "Only the paranoid survive." A famous quote from him, because he was on top of the world. Why is he thinking like that? Well, they are not anywhere near the top of the world
especially
now.
In technology. Especially in technology.
Well, in artificial intelligence, now a company called NVIDIA rules the world. One day they won't.
Right.
And he was right. The paranoid survive because you're going to get undercut unless you keep innovating and reinvesting and changing, especially in high tech.
Right.
So the point is, these enormous fortunes, Jeff Bezos, tens of billions of dollars. And some people think Elon Musk may become the first trillionaire.
Right.
But look what he's done. He's created a private space industry, And
his worth is not in cash.
Oh, it's
not even close.
Yeah, that's right.
And so if somebody says he's worth $400 billion, he doesn't have $400 billion. He has stock in companies that they say.
Well, the market is saying is tremendously valuable because what they think it's going to accomplish.
Yeah, but they're private companies, and so you don't even know what his Tesla is a public company. The rest of what he owns is private companies.
Well, whoever invested in it made some valuation of what it's worth, right? And
Yeah.
so they've raised money, and the investors help set a valuation at that time.
I suppose.
Yeah.
What I'm saying is that in Elon Musk's case in particular, there's so much stuff thrown around that I have no earthly idea, and so somebody says it's worth this, somebody says it's worth that. I don't know. I've not seen the financial statements. I've not seen anything. Do I think he's a genius? Yes, I think he's probably from a innovative standpoint. He's probably at the very, very top of the class. I don't think there's an innovator who is a greater innovator than Elon Musk. And our innovators, by the way, are what make it possible. I'm not an innovative person.
Right.
I just appreciate innovation.
And you invest in it.
And I invest in people who I think are extraordinarily innovative.
Yeah.
And so I'm more of I'm a business model investor, and I'm a people investor. So I invest in people I think are really smart, and I invest in business models that I think are really good in the sense that they're very scalable,
right,
for relatively small amounts of additional capital.
Scalable means they can get big fast.
They can get big fast. And by the way, every company that you mentioned and the ones that have been growing so much, they're global in nature. They're technology companies.
Right.
And so they don't require a lot of capital to grow. And that's why profits, when we're getting back to the term of the moment, and that's why businesses that serve us from a product standpoint, not from a technology standpoint, that's why how they are able to make money, and if they don't make money, then they can't grow. And if they can't grow, then either prices are going to go up because there's not more competition, or there's not more availability of product, or the consumer's not going to have choices. And so we should want, when we hear politicians say profits are too high, we should want, in a free market, we should want profits to be as high as they can be, because that means that the companies are growing. It means employees are probably going to be making more money. If you're working in a high-tech company, your average salary is much higher than if you're working, say, in a grocery store business, or in a retail business of any kind.
Because their margins are just a couple of percent. They cannot pay.
Right.
They can't let their pay get out of whack, or they're out of business.
Right. But if you're in a technology company like a Salesforce, for example, you have companies that license the use of the Salesforce platform. An additional company licensing that platform doesn't cost Salesforce hardly anything. I mean, literally a nano penny.
Yeah, so finding new customers, creating new offshoots of your product, very valuable. I had a classmate who went to work for a PepsiCo, I think, and he said every 1% of market share was worth some enormous number, like $10 billion or something. So they would spend money prolifically to try to get another tenth of a percent.
Yeah, but they're taking that away from somebody else. That's not accretive.
In a mature market, they are.
Yes.
And it's very expensive and hard to do. That's why you need highly skilled people in marketing to try to do it, and generally not very successful.
Right.
But it's better to be in immature markets where, this year it's $100 million, next year it's $500 million, 4 years from now it's $1 billion market. That's where the real money is made.
Yeah, and then there also, you get companies like, as I said, I was a Converse distributor, and we were Converse distributors from 1977, and we sold that business in 1990. Well, Converse ended up going bankrupt in 2002, and Nike bought the name Converse out of bankruptcy.
Right.
And so the Converse All-Star is still available, and people still buy them, but they're a Nike product.
Right.
But then Nike became a very, very big company, and owning the Nike stock was a tremendous investment for probably 25 years. But then since then, you've had Under Armour, you have all kinds of other competitors who've come into the shoe space or the apparel space. And so as you point out, there's always innovation, there are always new brands, there are always new consumers, because people who are 15 today, in 5 years, they'll be 20, and they will think differently. What brands they identify with could be very different than the brands of yesterday. But we're getting kind of off point here.
No, we started talking about markets, and I wanted to say free markets are the institutions that handle this kind of dynamism.
Right.
To the degree they're limited, we sedate ourselves.
And we also we're talking about capital. And let me say this: if you tax capital at a very, very high rate, and you hear a lot of people saying we've got to tax the billionaires, we've got to do this, we've got to do that. If you tax capital at a very high rate, you will not have innovation, because innovation is the investing in pure innovation. That's in the basic research. That's in how to take basic research and commercialize it. All of these things are very, very risky. And so they require, in order to attract investors to invest in that, the investors have to see that if the investment is successful, they will get a high rate of return.
Right.
But if the government says, well, if you get a high rate of return, we're going to tax that high rate of return, they won't make the investment in the first place.
Well, either one, in the ones that become failures and the one that become successes, they will just stop investing in either one. They don't know which they're going to be. That's why you diversify,
Well,
right? And so you lose 100% of a bad investment.
Exactly.
And if you now are not making 100% of your good ones, but making 50 or 30%, you got to do 3 times as many.
You won't do that.
You won't do it.
You'll choose to invest in something else, and then innovation will not happen. Which is why, by the way, the big innovative companies are U.S. based companies. They're not based. Europe is the EU is bigger than we are in terms of population. It's
by about a third, I think.
Yes, it's not bigger than we are economically, and the innovative companies of the world are all based in the U.S., and that's because we treat our capital, we treat the profits that come from capital investing. We don't punish it. I'm not going to say we reward it, because that would imply that we subsidize it. But we don't punish it.
Right.
And if you don't punish investors, they will invest.
Right.
If you punish them, they won't.
And foreign investors will come here to put their money.
Absolutely.
Do it.
Yes, and we're seeing that. We're seeing that now. So let's move from profits, and I think we've talked about the profits. We've talked about what profits are, and we've talked about how businesses take their profits and use them to expand their business, not to pile up cash in a bank.
And a free market will operate in the interest of the purchaser to push the price down.
Right.
So these excess profits we were talking about, the point I wanted to get to with that is that they may last for a little while. It's a reward for doing something really good. But in 10 or 15 years, patents expire, it becomes a common interest, and those profits get competed away. You got to do something else to make big money.
You always have to be improving. You always have to be improving, either improving the product that you're making or finding new products to make or sell. If you're going to remain successful. And so the last thing we want to talk about here is wealth. And we're talking about now wealth at a personal level.
Yes.
And what I wanted to do is I wanted to talk about the magic of compounding. This is from an individual standpoint. If a person invests $1,000 one time at age 20, and they invest it in something like an IRA, or something that is not taxed at all until they reach a certain age or until they close the account or whatever, but it's not taxed. And they get a 12% annualized return. And by the way, the stock market over, I think, like a 60 or 70-year period is like an 11% return over a long period of time if you include dividends.
Okay.
And so it's important to include them both, because in this type of an account, neither one is taxed. And so a 12% return, invested $1,000 a single time.
And you're using 12 instead of 11 because the math is easy.
Because the math is easy.
Right.
A simple rule is to take the number 72 and divide whatever it is. And it has to be a relatively small. You can't divide 72 into 72 and double it.
Or 70
you
or
can't
65.
Do that. Yeah.
So you need the normal range of growth, which is 5 to 10 to 15,
right.
something like that.
And so if you 12 divides into 72 6 times, which means every 6 years, something that is growing at 12% will double.
Double. So it's the rule of 72s, is what that's known. It's a rule of thumb in the financial industry. You divide 72 by the growth rate, and it gives you the number of years it takes to double.
To double.
So 72 divided by 12 is 6.
Yep.
It doubles every 6 years.
Yep.
Okay.
So if you take $1,000 and you invest it and it grows at 12% on average, and for 48 years. So you're 60, you're 12 years old. Now you're going to, it's not 12, you're 20 years old. You're going to be 68 years old.
Right.
That $1,000 becomes $256,000.
Because it doubles, which is 48 divided by 6.
Doubles 8 times.
Doubles 8 times.
Yeah.
So you take 1,000, 2,000, 4,000, 8,000, 16, 32,
64, 128, 256.
That's 8.
And then the next 1,000, it's not quite 256. But so
the
if
one
you
do the next year.
The next year. So if you're investing $1,000 a year starting at age 20, and you do that for 20 years, you will be, by anyone's definition, financially independent when you reach 55 to 60 years old.
So we've switched words here. We're talking about wealth, and now you've said financially independent.
Right.
And that's because we equate the two.
Right. Right. A person who is, if you say, well, what defines a wealthy person? And you can say the super rich. Well, they're certainly wealthy, but what's the minimum standard for being a wealthy person? And my answer to that is a person who is financially independent, which means that they can live on the income and the assets that they have built over time without working.
A brief aside here. Some people think a wealthy person is somebody who has a high income. Okay, there's a lot of professionals, the lawyers, doctors, executives. They may make $1 million a year. They spend $1,020,000 a year.
Yeah,
they're not wealthy.
No,
they're not financially independent. They depend on that income to stay there. They get fired, they're in a world of hurt.
Right.
Okay, so wealth, you and I would say, is tied to assets more than income. Now, income produces the assets. It's the profit that accumulates, right? So they're not completely independent.
Right.
But really, wealth has to do with assets. Financial wealth has to do with financial assets.
And financial independence has to do with the assets that you have at a point where you are if you're no longer working to produce income, but you can still support yourself in a standard of living that you like, then that is by definition a financially independent person. Now, some people might say, well, that's not what I call wealthy. I said, I don't care.
You can choose and do different math.
Right.
Yeah, for a different definition. But let's look at how easy it is to calculate what you need to produce an independent standard of living, okay? Let's just use, for purposes of calculation, $100,000 a year is probably enough for most people to live like they want to, depending on what state you're in. In New York City,
that's a nice
it's not
round
great,
number.
and we can calculate easily. Right. If you I use the number 7. You use 12 as what the stock market, or 11 is what the stock market does. Generally, we have to pay some taxes. We take things out, and we don't put things, So let's just use a lower number that's a little more conservative. Let's take 7. Okay. 100 divided by 7 is 14. Okay. So how much money? 100% of what I need 14 times what I want to make every year.
So you need about $1.5 million.
About $1.5 million. It's 14 times 100,000. So that is wealth. And by the way, that needs that amount of money.
Yeah, and that $1.5 million is not part of your home. So it's not like you own a home debt-free.
Well, you're not, unless you're selling off pieces of your home. That's hard to do. So exclude that. You need $1.5 million in an account somewhere that you can sell off. Right,
that you can sell off or that you can earn. Yeah. I mean, it's not like that. It's not like that $1.5 million can't earn money. So it's not. You're not really selling it off. You're earning 7% on it, and so the $1.5 million more or less stays the same.
Yes.
And you're using 7%, the earnings of 7% to live.
That's right.
And so that's what we're calling a person who is financially independent.
And let's relate that to what you said a minute ago. 1,000 invested at age 20 becomes $250,000.
Right.
Roughly.
Right.
You need 6 $250,000 to be $1.5 million.
Right.
Right. So you need to invest $1,000 roughly 6 times.
Right.
And let it compound over 48 years, and you've got you're wealthy.
If you do that when you're young. And so this is the key takeaway here. And by the way, invested capital rates of return, the stock market does not care what your race is if you have an IRA. And it is particularly
or your gender.
It is particularly distressing to me when you hear people who claim that our society is fundamentally racist and it cannot be fixed. Well, if a person who is black invests $1,000 a year and uses an IRA, which everybody can have, and invest that in an equity fund that goes up at 10 or 12% a year, and they do that $1,000 a year for the first 15 years of their work life, they will absolutely be financially independent by the time they're 55 years old. And then if they live on the income, and then they turn it over to their children, or most of it to their children when they pass away. And that's how generations live better than the previous generation.
Right.
And so it's important for our listeners to understand that you can become financially independent just by making wise decisions as early in life as you possibly can.
So let me ask you this, or tell you this. My mother says she grew up on a farm in West Tennessee, and her father told her, I could have bought Coke stock for a nickel a share. It's now hundreds of dollars a share.
Oh, thousands,
especially
probably by the time
adjusted after splits and all
yeah.
that. But I didn't have a nickel. That was his answer. And he didn't. He had a bunch of kids. He had a farmer's income. He just did not have the surplus income to buy Coke stock. So what do you say to somebody who says, I don't have $1,000 to invest every year. It takes everything I make to live.
If your income is so low that you're using everything that you possibly can to live, what I would say to that person is, whatever job it is that you have, study the job that you have and figure out how to do that job better. Because, for example, you hear people disparage hamburger flippers in fast food restaurants, or you talk to the people who operate the drive-through window. If you start out in those positions, and those positions don't pay a lot of money, you may not have $1,000 that you can put in an IRA, but if you work full-time for McDonald's, I'm confident that they have savings plans.
Some kind of plan.
Some kind of plans, but I'm going to stick with that. But if you pay attention to the way that store operates, that location operates, then it won't be very long before you're offered to be a shift supervisor. And then if you're a shift supervisor, your income probably goes up $10,000 a year, maybe $15,000. And then if you really are paying attention and working hard, then you become the manager of the store. Or you become an assistant manager of the store, would be an interim step. Now you're making $80,000 to $100,000 a year. Well, those people can clearly save $1,000. And by the way, if you're a little bit behind to begin with, then invest $2,000 a year when you can. But the point is, and you pointed this out in what you talked about earlier, is it said defer some spending. Make sure that you have in your budget. You have money taken out of your paycheck. And let me mention one other thing before we get off of this, and that is the importance of investing every single month. The reason for doing that and not investing once a year, it's what is called dollar cost averaging. So if the stock market, let's say just to make it really simple, you're buying only one stock. That's not advisable. Let's say you're buying only one stock, and that stock goes from $50 to $25. Well, you might say, oh gosh, that's terrible. All the stock that I had just fell in half. But if you are now buying every single month, you're now buying shares
at the low price
at $25.
Right.
And then when that
so
stock
it smooths out the ups and downs.
Well, not just that. When that stock goes back to 50, it doubled for you
right.
on what you bought for 25.
Right.
And so the key is to not try to say, oh, I'm going to only buy when the market's down or when the market's up.
You can never tell.
You can, and then the trick is when you get older, then you want to recognize that you don't want to be in a down market when you're older and you don't have time to recover.
Right.
But when you're younger, quite frankly,
got a long time to recover.
You got a lot of time to recover, and you ought to be saying, gosh, I hope the stock market goes down because then I get to buy cheap.
That's what Warren Buffett says. I like it when it goes down because I can buy on sale.
Yeah. And so investing every month as opposed to once a year.
Yeah. There's a behavioral reason for that too, because it becomes a habit.
It becomes a habit, and it comes out of your check before you even get a chance to spend it.
So we've kind of emphasized the income side of this, get to be a shift supervisor, find ways to produce more value, get better educated.
Become more valuable. That's the key word here. Become, as an individual,
right.
Become more valuable. And by the way, if you're in an industry where there's lots of competition and you become more valuable in one particular business and they're not promoting you there are other businesses that will absolutely hire you and pay you more.
In a free economy, even more.
Yes.
Again, we're back to freedom. If people are not burdened by committing to employ you forever and they can't fire you, then they're not going to hire as many people. Those markets, like in Europe, that's what happens.
Right.
They can't fire people easily, so they don't hire them very easily.
Right.
So in a free market, there are not very tight limits on how valuable you can be.
Right.
There's a lot of ordinary people that have become extraordinarily wealthy and valuable because they just paid attention and persisted.
Yeah, and that's what's key is the persistence, getting better at what you do, because then you are more valuable.
Right.
And then having a very, very consistent savings plan, and then even if you invest that money there are companies now like Robinhood, where they'll take money from you every month,
right.
and they invest it for you.
Yes.
and then there's a company called Acorn. And you sign up with them, and every time you do some kind of a credit card purchase, it rounds the purchase up to the next dollar and takes that money and sticks it in your Acorn account.
And presumably you never miss it.
And so what I'm saying is that there are lots of ways for somebody to invest, even if they don't know how to invest. There are lots of places where you can go where people who do know how to invest, and also, quite frankly, you want to support economic policies where the economy itself will grow. Because if the economy itself is growing, then your invested capital is becoming more valuable. Your opportunities become greater. And
let's look at one more side of this, because getting more valuable sometimes requires investment to go to school, take a risk on a new job, some things like that. Sometimes you don't have the opportunities you wish you had. It's not as controllable as what I'm about to suggest, which is controlling your expenses. Calvin Coolidge said the ultimate source of prosperity is living within your means.
Right.
Which means you always spend less than what you have. You don't borrow money to have today and then have to pay it off plus interest. You wait until you've saved it up, then you buy it.
Yeah.
Right. And so the point here is that there are lots of ways to trim expenses.
Mm-hmm.
I used to work with a guy that would come in the office with 2 cups of Starbucks every day. Okay.
Oh, geez.
Now he had plenty.
That's $10 a day.
$10 a day. He had plenty of money. Okay. This is not really going to hurt him. I think he did fine. But I looked at that and I said, that is
$2,500 a year.
Yeah. It's a lot of money, and that's after tax.
Right.
Okay, this is the other point I wanted to get to. To buy that $2,500 in his tax bracket, he probably had to earn something like $3,500.
Right. Okay.
Warren Buffett uses this. He says, "Do I want to buy this haircut today for $300?" What he means is, if I don't buy a $50 haircut today, if I save it in a certain length of time, it's going to be $300. Back to our compounding interest. So he's 90. This doesn't apply anymore. But when he was young, his point was, if I skip my haircut and save $50, it's $70 I didn't have to earn. I put that away.
Right. Yeah,
and you're wealthy. So the point is, little expenses trimmed off.
Yeah.
And if you adjust for taxation, you're going to have to pay tax on that income to buy it. And you put it in pre-tax, meaning it's deductible from your taxes.
Right.
Then that's how you build wealth.
Yeah, and it's conscious.
Right.
This doesn't happen. This does not happen unless you consciously do it. And as you pointed out, having the money taken out and put into an investment account is you then learn to live on what you are getting, and that then becomes that's not money that you think about. So at any rate, Michael, so let's just recap here. We've covered, and I don't know that we've done a great job of covering this because we've probably talked more than we needed to, but we covered what markets are. And I think that's very, very important for people to understand that there are different kinds of markets, and free markets where all the players participate equally is by far the most productive for prosperity in general.
And to the extent we can, we should advocate for those kinds of markets in public policy.
Right. Right. And then you have, and by the way, that's not just at the federal level. That's at the state and local level too. Yes. Because we've talked about the cost, the government, whether it's good or bad, the more the government you have, the more costly it is. And so you can argue about whether you should have some or none. And that's generally what people say. Well, you're for anarchy. No, I'm not for anarchy. I'm for as small a government as we can possibly have. And I also, well, at any rate, so then we talked about what capital is, and how to think about capital. Then the most important thing I think we covered today was what are corporate profits, because a lot of people think that corporate profits are money that's just accumulating and sitting in a bank, and that the fat cats are sitting there doing nothing with it. And that's not the case. Businesses take those profits and they reinvest them in the business to grow the business, which makes the shareholders' shares more valuable if they've invested the money wisely. And then the last thing is,
if you've ever heard of a hostile takeover, it's somebody outside that company that's looking at them saying they're not doing the best with that. I'm going to go buy it out and do better.
You're right. That's a great example of what happens if people rest on their laurels and just sit on their cash and decide to make a big personal income, but don't do right by the shareholders or the employees, or frankly even the customers.
Right.
And then the last one that we talked about is personal wealth, and with the goal of being financially independent and how to think about that.
I want to add a point here. My dad used to say to me that a wealthy man is somebody who has his health.
Well,
okay. So what I want to get to the point is, again, financial wealth is a means to an end.
Okay.
You know, if you get sick, it allows you to buy doctors and things like that. But the point is, well, let me tell another story. There was a very wealthy guy here in town, billionaire, who got pancreatic cancer. And he died within about a year. And I'm told that somebody asked him, would you trade all of your wealth for your health? 5 seconds.
Oh, yeah.
Absolutely.
Yeah.
No question about it. Right? There are things way more important than financial wealth, but it does empower people to make the choices they want, to do the activities be around the people they want to be around, to pursue the objectives that they would like to see happen in their life. I went to a very good business school, and generally people are not going there to just get wealthy. Some of them are, but usually they're going to be empowered to do something really constructive with their lives.
Yeah, and saving money and becoming financially independent while all of the different things you're talking about, people have they feel more fulfilled. They have more self-confidence because they've been able to accomplish goals that they set out.
Well, and helping others. You know, one definition of responsibility is meeting your own needs and having enough left over to help others.
Yeah, and that's why I said when people have built up an estate that they can live on and they can pass on some of it to their children, they might pass on the rest of it to different charities wherever
they think it's best needed.
Yeah. Okay. Well, Michael, I hope that this was interesting. We covered markets.
I thought it was interesting.
We covered markets.
You're talking to our listeners.
Yeah,
now, right?
I hope it's interesting to our listeners. Yeah, you bet.
All right. See you next time.
Yep.